Silver just crashed 31% on a Friday afternoon. Worst day since 1980. Gold had its sharpest decline since 2013. If you're heavy in silver heading into that morning, say $500,000, by the end of that day, that $500,000 is now $345,000 by the close of the day. Gone. Poof. In a few hours. And not one person I spoke with that weekend, these people are with serious metal positions, had heard from their financial advisor. No call, no email, nothing. I mean, honestly, what are they supposed to do? So I want to walk through what actually happened and what it means for your allocation going forward, and why the silence from your advisor might be the most expensive part of the whole thing. You see, Trump nominated Kevin Warsh to replace Jerome Powell as Fed chair, and the market's reaction was immediate, not in the direction most people expected. For months, precious metals had been on a tear. Gold was above $5,000. Silver was up over 150% year over year. And a big part of that rally was driven by one fear, that Trump would appoint someone who let the printing press run hot. A puppet who would just slash rates, debase the dollar, and let inflation rip. Warsh is the guy who literally resigned from the Fed in 2011 because he thought the bond buying had gone too far. So when his name dropped, every trade built on the cheap money forever thesis broke at the same time. Deutsche Bank's Jim Reed put it simply, Warsh is more hawkish on the balance sheet, and his nomination pushed back against the prevailing debasement narrative that has been supporting precious metals. So what happened wasn't a crash in the traditional sense. It was a thesis unwind, meaning billions of dollars had been parked in metals based on one specific bet, that the Fed would lose its independence. When that bet broke, Morgan Stanley's quant desk flagged what they called massive forced rebalancing. Leveraged silver ETFs alone had 3.5 billion in forced sellings in a single session. Now stay with me here, because this is where it gets directly relevant to your portfolio. Warsh is walking into a triple problem that Fortune just published a piece on. He wants to cut short-term rates. Trump definitely wants that. He wants to shrink the Fed's $6.6 trillion balance sheets. That's his core conviction. And he wants to pull up both without triggering a liquidity crisis. Here's why that matters to you. If the Fed stops buying bonds to shrink the balance sheet, long-term yields go up. And if you're holding $1 million in bonds with a 7-year average duration, a 50 basis point move, that's 0.5%, knocks roughly $35,000 to $50,000 off your position. And that's not hypothetical, that's the math. Your real estate financing costs shift. Your metal thesis shifts. Cutting the short rate could weaken the dollar, which reshuffles the math on anything you hold overseas. The dollar spiked 0.8% that day of the announcement alone. 5 distinct portfolio implications from one announcement. Every one of those shifts affects your allocation. So next time you're on the phone with your advisor, it's worth asking, what are we doing about any of this? And in fact, if you want to save your breath, just forward them the link to this video. Let me paint a quick picture. Someone I spoke with last week, he's in his early 60s, built a successful business, about 1.8 million in investable assets, had roughly 15% in precious metals as an inflation hedge. That was a good instinct and a reasonable allocation. On January 30th, that metals position lost approximately $80,000 in value. That's in one day. He called his advisor that afternoon. It went to voicemail. Got a call back Monday. Not from his advisor, but from his junior associate. The message was essentially, stay the course. Markets are volatile. This is normal. Now, I'm not saying that advice is wrong. Maybe holding is the right call. Wisdom Tree still projects gold hitting over $5,000 by year end. JP Morgan has it at $6,500. But that's not the point. The point is, he's paying roughly $18,000 a year in AUM fees for a relationship where a 6-figure single day loss didn't warrant a same-day phone call. And look, it's not because his advisor is lazy. It's structural. The average advisor at a major firm is managing 200 to 300 client relationships. When a market event hits like this, they physically can't call everyone. So they triage. And if you're not in their top 20 accounts by asset size, you're getting a foreign email 3 days later, if that. Plus, the AUM model doesn't reward them for calling you. They collect the same percentage whether they pick up the phone at 2 p.m. on a Friday or send a quarterly report in April. There's no incentive built into the fee structure for urgency. And that math is worth sitting on for a second. And that is what got my attention. Within 24 hours of the Warsh announcement, institutional desks weren't just selling metals, they were rotating into the exact classes that benefit from a smaller Fed balance sheet. And most of their clients' individual advisors were still drafting a stay the course email. Here's what the institutional lens looked like on this event. Warsh wants to shrink the Fed balance sheet. That managed the Fed steps back from buying bonds. Someone has to fill that gap. And Warsh has talked about reducing the Fed's role in bond markets and letting commercial banks fill it. Analysts call it privatizing QE. That's why JP Morgan, Goldman, and Wells Fargo see upside from his appointment. For an individual investor, the read-through is this. If the Fed reduces its footprint in bond markets, private credit, and alternative lending, these become more interesting, not less. The Invesco analysis on Warsh's nomination said it directly. Alternative investments, real estate, private credit remain attractive hedges regardless of who chairs the Fed. Now, alternatives aren't simple. They're illiquid, they require due diligence, and they're not for everyone. And they require somewhat painful rehabs, like the one you see behind me. But the institutional approach isn't about picking the perfect asset. It's about having an allocation framework that already accounts for policy regime changes. So when the announcement hits, you're adjusting dials. You're not scrambling. And the data on what happens when the framework is missing is stark. AssetMark tracks down why high net worth clients leave their advisors. Among clients with 5 million or more, 63% who left cited lack of timely communication as the primary reason. Not performance, communication. The richer you are, the more you expect your advisor to pick up the phone when something moves your portfolio, and the more likely you are to leave when they don't. So here's what this really comes down to. The Warsh nomination isn't just a news story, it's a stress test, not for markets alone, but for you, for the relationship between you and whoever manages your money. A Fed chair transition of this magnitude, where gold has its worst day in 13 years, where the entire monetary policy framework is potentially shifting, where there are 5 distinct portfolio implications that need to be addressed, that's exactly the moment your advisor earns their fee, or they don't. And if the answer is they didn't call, then the question isn't really about Kevin Warsh. It's about whether you're paying for a relationship or a quarterly PDF. But here's the thing, it just keeps nagging at me about all of this. We just watched silver lose 31% in a single day from a single political announcement. Meanwhile, I own rental properties that deposited the same cash flow into my account on January 30th than they did on January 29th. No margin call, nor forced selling, just a tenant paying rent. And yeah, the appraised value, it moves around, but the rent check doesn't crash 31% because of a political announcement. There's no margin call on a deed. That's not because I'm smarter than everyone. It's because real assets on a deed don't have a ticker symbol that panics when a headline drops. Now, I've talked a lot on this channel about the institutional side, the allocation data, the endowment models, but I've realized I've never really walked through the mechanical side of it. How someone with a serious portfolio and a full-time career actually adds a real asset without it becoming a second job. Because that's the part that stops most people, seeing a busted up kitchen like this. And that's why I pulled this video out right here for your next watch. It walks through the acquisition math, the financing in today's rate environment, and how the management side works, so you're not fielding calls at midnight. And this is worth seeing, especially with rate expectations shifting under Warsh. I think you'll find it interesting, and thanks for watching.